Brian, it's great to have you here. Amidst all
Thank
of
you.
this, it's earnings season. I mean, there is just no clarity whatsoever. What exactly can analysts even hope to predict about what these numbers will look like?
Yeah, I mean, there's not going to be clarity on earnings or economic data for a while. So, yeah, at some point, these numbers, I mean, they're going to be bad. We know they're going to be bad, and at some point, the market's trying to look through that. And remember, we priced in a pretty nasty recession in a month. I mean, we usually do that over a couple of year period. So, the market down 35% in 1 month is pricing in a lot of this damage. The question now, of course, is how effective can policy be bridging us through a point when we can reengage? So, investors should continue to expect really bad economic data and a very, very difficult earnings season.
So Brian, I mean, let's take it. Your job is to put up strategy. So how exactly, as a strategist, do you navigate around earnings reports this time around? Are there key indicators that you're looking for? Do they even matter at this point? What exactly kind of commentary are you looking at to see whether or not there is a path forward, or what businesses will look like on the other end of this?
Unfortunately, in the near term, what you really need to be looking at is more of the epidemiological in terms of, where are cases going and how are we ultimately going to get people reengaging in the economy again? And then you need to be watching financial conditions, in that policy is providing support here. So there's not going to be near-term clarity from a lot of businesses. Now, the good news is, Americans need to realize that, or global investors need to realize that the earnings and GDP are going to be a bit different. So there are some companies that are going to get through this relatively okay. And, you see a lot of where earnings come from in the broad indices are going to be things like software or banking. And, some of that will come through better than the parts of the economy that are more arts and entertainment related, or general merchandise retail, or for now, energy. So, it's going to be a mixed bag. And, what you want to see, of course, is, those parts of the market that are still open and that we're still engaging with, producing decent numbers. Again, we should expect arts and entertainment and retail and energy to be, particularly weak for some time, until we start reengaging again in the economy.
Brian, what do you think is happening right now with the markets? I mean, we have surged around 25% in the S&P 500 in just a couple of weeks from those crisis lows. What's driving the positivity right now? Is it not just the coronavirus headlines? Is there technical? Is it short covering? What in your mind is it?
Well, look, we priced in a pretty nasty recession quickly. And then the question from there is, do you need to go further and price in a financial crisis, or, God forbid, even a depression? And policy has responded significantly. So given that our policymakers have studied the 1930s and that we've all lived through 2008, we had a response that was drastic, aggressive, significant. And so the markets have responded to that, and particularly the bond markets, rightfully so, as the Federal Reserve becomes very aggressive. So we're following a pattern. A low comes in, you recover off of that amid a policy response. And a lot of the market bottoming indicators, a lot of the technicals, whether it's extreme pessimism or, how positioning did signal that you were starting to put in a bottom. The question now for everyone is there a catalyst to go higher? And, that catalyst has to be an improvement in the caseload and reengaging. And we're probably not all the way there yet.